Hello, and welcome back to the Foreclosure Deals Coach podcast, the show where we discuss how you can find, figure, fund, fix, and flip a foreclosure deal. And today's show is going to be all about the recent minor drop in interest rates. Going to be a great show. Stay tuned. Hello, and welcome back. I am Donny Coram, your host of the Foreclosure Deals Coach podcast. This is the show where we help investors just like you to find, figure, fund, fix, and flip a foreclosure deal right here in the local market. We're working in two markets right now, the Colorado area, so Colorado Springs and just south of Colorado Springs, Pueblo, and now we're evaluating the Arizona market to hopefully be in by fourth quarter of this year. A lot of talk going on in the real estate market. You know, it's a weird time. The best way to describe the current real estate market is weird. So how do you navigate the choppy market that is real estate most of the time? There's always some kind of dynamic that's shifting the market in some way or manner. How does the investor keep this kind of thing straight? Well, there are some fundamentals that you have to look at as part of your investing process. And I want to take a step back on that a little bit. And that applies to any sort of investing strategy, right? You've heard the fundamental probably of dollar cost averaging in the stock market, where you're buying the stock every single month at the same time, right? And you're benefiting from the dips in the stocks. You're ultimately getting it for less expensive at certain times. You're paying more for it at other times, but because you're averaging it out, you're getting a consistent return or a consistent number that you buy the stock at. Real estate investing is not unlike that. There's a strategy to follow where you look at certain fundamentals. One of the big fundamentals, and there are several, but you got to look at inventory is a big thing. And inventory gives you an idea on the supply and demand curve right now. Where are we on inventory right now? Well, inventory is pretty high by comparison. You know, we have a lot more homes on the market than we have had in the past couple of years. I read something that inventory is the highest it's been since 2015. So nearly 10 years, we are currently at the highest inventory level we've seen. So that's a bull indicator, a bearish indicator on the market. If inventory is high, we would be looking at obviously prices should be coming down, but they're not. Like currently prices are kind of holding pretty steady. Houses seem to be quote unquote overpriced to the masses. But the reason that feeling of overpriced is coming in is largely tied to the second factor you got to look at, which we're going to discuss in more detail today, the interest rates. And interest rates really determine the buyer's buying power. I think the reality is people really want still to buy a home. It's kind of the American dream. I remember, my parents, when I was very young, looking to achieve that goal of buying their first home. And we did so right here in Colorado Springs, Colorado. It was the mid 80s. The property was in Briargate, which, no one had any idea was going to become as big or popular as it became. They bought that house on Sweet Gum Terrace, 8490 Sweet Gum Terrace is my childhood address, right? We bought that property for $90,000 way back in the mid to late 80s. Lived there for several years. That's where I spent a lot of my childhood, going into high school and et cetera. And then right as I graduated from high school, they sold that property and moved to the Northgate area off of Baptist Road, where they currently live today. So I bring that up because buying power back then seemed very low because interest rates were higher in that era. There were ebbs and flows and dips, but you definitely were seeing higher interest rates in the 80s and in the 90s than even what we're looking at now. Right. So today, the interest rates have been wandering largely around 6.8, even up to 7%. And this is a stark contrast to where the rates were in 2019 and 2020, where because of COVID and various other sources, the administration pumped a bunch of money into the market to salvage the market and ended up getting rates looking in the 2s and early 3s. It was a staggering time. Buying power of the buyer went through the roof. And as a result of that buying power, prices started to soar. We saw 30 to 40% annual increases in home prices for a 1 to 2 year period. It was absolutely insane and obviously unsustainable, right? We knew we couldn't keep that up. To counter that, the powers that be, the Fed, started to raise rates drastically in mid 2022. The rates went up extremely high, and then that's kind of where they are today in the mid to late sixes, and that's where they've stayed. As a result of that, we saw a significant decline in the number of sales in the housing market. It's kind of logical. If people can buy less property, they're going to buy less property. It didn't really push prices down, which was my initial response. Say, okay, we're going to see a big dip in prices. That's not what happened. Instead, what we saw is a lot less transactions. We're definitely selling less houses today than we were, and by a factor of roughly 60 to 70% of the total sales volume of the marketplace here in the local market anyway, as opposed to the last couple of years. Okay, so sales volume is down, interest rates are high. What is happening today? Well, we have seen, I think the government is starting to understand that raising rates to that degree that fast was an overreaction to the market. How many times have the government overreacted to the current situation? Pretty much every time, right? Instead of doing a gradual rate increase, which would have been the right move, gradually taking money out of the market, they locked the brakes up, raised rates to a staggering proportion, and that's where we're looking at today. We have these really high interest rates and really high home prices, making the buying power of the individual very difficult for them to buy a home. But furthermore, inflation, which is what they were trying to check because they did this interest rate, they were trying to reduce inflation. Everything costs more. Fuel is more, food is more, just utilities are a lot higher, etc. So the buying power of the entry-level buyer in particular is extremely limited. Well, the entry-level buyer is truly our bread and butter in the foreclosure market, whereas there are in fact foreclosures in every price bracket. People think that foreclosures only plague the entry-level market. The reality is every price bracket sees foreclosures at some point or another. However, you see a lot more of them. Obviously, people who are buying entry-level homes, buying their first homes, they don't have the equity backing. They don't have the financial knowledge, right? There's some limitations when you're buying your first home. I certainly remember that when I bought my first home. There's a lot of stuff I didn't know back then, right? There's a lot of stuff I still need to learn. Right. But there's definitely a learning gap with new buyers first coming into the market. So we see a lot more foreclosures in that segment of the marketplace. And they're affected more by the higher interest rate. Whereas if the rate goes up 2% and the payment on a $750,000 house goes up by $1,000 a month, let's just say, that's a lot of money, but it's not as much money for a guy who's already planning on a $3,500, $4,000 payment to go to $5,000. He may not want to, but he can. That's the big variable. That same impact on the entry-level buyer is far more pronounced, right? If they were just getting by on a $1,500 payment, then going to an $1,800 or $1,900 payment is going to prevent them from buying a house at all. And that's what we're seeing right now, where there's a struggle for the entry-level home buyer to buy homes. Now, this is not to say that they aren't buying homes. It's that they're being a lot more picky about which homes that they buy. And they are obviously factoring in the interest rate. Has some push, obviously, and people who might have bought a home in the 300 to the 350 range are now looking at the 250 to 200 range because that's where they can afford the payment at that rate. This is actually good news for us as investors, and why we moved a lot of our focus to the Pueblo market in lieu of the Colorado Springs market. Why? Well, because we can buy a house in the Pueblo market still for the early 100 to 125 bracket, with the thought that we're going to sell it for 210 to 215, leaving about 100K spread. It reduces our cost because there's a lot of holding time right now because it's taking longer to sell. So we got to factor in a couple more months of holding time, which we didn't have to in the past because houses were selling faster. So that just makes the deals more lucrative at the entry level. Okay, so this is a long way to get there. And I know this is not a super exciting economic discussion, but it needs to be. You need to really understand that the idea behind this is that if you can predict or head to the market, that's where you make the most money. Wayne Gretzky said it best. The way he got successful at hockey was trying to learn where the puck was going to be. Okay, nothing could be truer in any finance market. What if you could have predicted Apple's rise to growth, right? In the 80s or 90s, how many products they were going to sell, right? We're having this conversation on an Apple device right now, or Nvidia, who saw that one coming, right? The idea that you can predict what the market's going to do next is the goal, and in doing so, you can make a lot more money in any sort of investing product, but particularly in the foreclosure investing space, anticipating where the future growth market is going to be is a critical element in all real estate investing, particularly the foreclosure market. So That's a long way to say we are anticipating that rates are looking at a decline in the near future. The government has realized what they've done. They understand they may have halted the economy a little bit too much. This is all my opinion. I don't work for the government, but based on the news that I'm reading and my talks, and I try to keep in touch with mortgage brokers, and I try to watch the finance news and watch the Federal Reserve meetings and get a feel for what's going on in the finance space. And based on the data that I'm getting, the interpretation is that rate cuts are imminent for the foreseeable future. What does that mean to the investor? Well, now, and it always is the case that now, but now is the time to get into a deal. Because if you can get into a deal now and you have 1 or 2 months in construction, by the time you're getting out of that deal, some of the shade that is currently shadowing the market, including the interest rates, and of course, election scene is a huge problem right now. The division it creates in the country prevents people from wanting to buy homes in this market, right? That's a reality of the times, right? People are hesitant. Regardless of your political stance on this, if you don't know who's getting elected next, then that creates some uncertainty in the marketplace, and that's preventing a lot of buyers from wanting to enter the market right now. So as I'm talking with my clients, both prospective clients and future clients, what I'm trying to relay to them is people who bought homes in the last 6 months, and obviously I sold a lot of homes to clients. We got clients into deals in the last 6 months. We've been operating as normal. But we kind of got caught in a bit of a vortex. They're definitely taking longer to sell than we would have guesstimated. Some of my clients are now being forced to refinance the property out of the hard money loans into more conventional financing to keep it as a rental for a while until things improve. And obviously, as the guy who's providing the advice, that's not ideal. That's not the exit strategy we were hoping for. But the reality of the investing market overall is there's an inherent risk to all investing, right? And I'm not encouraging people to get into risky situations. I'm simply saying that if you're going to do this, your risk tolerance has to be a little higher than the average bear, right? You can't get into this hoping you're going to get expecting 20% annualized, 25% returns, but coupling that with the same risk you get by sticking in a savings account or treasury bill or some other lower yield investment. The idea behind risk versus reward is you take a higher risk, you get a higher reward, but it does come with some caveats on that, right? So what does the investor do today? Anticipate. And I'm anticipating that rates are going to come down in the next few months. I'm anticipating that right after election season, we're going to see a lot bigger a drive into the real estate market because people are going to be more certain once the new president, whoever it is, happens to be elected. And I'm anticipating that we're going to get buyers back in the market because you have to understand that the demand never really goes away. It's not that buyers don't want to buy homes right now. It's that a lot of them can't. Okay, and that's a big variable. It's not that home ownership has become less than desirable. It's just become too expensive for a lot of people, so they're waiting it out. They entered leases a year ago, maybe more, right? Those leases are going to come due, and they're going to go out and look for property again. Today, as it sits, whereas we were at 6.8, we are at 6.7, 6.8 for a conventional loan. I have mortgage brokers as clients and friends who are reporting that they're signing VA loans right now at 5.7, 5.8, upper fives. This is a good sign, right? And it's expected to get a little better if the Fed drops the rates. The next Fed Reserve meeting, I believe, is in September. We're expecting a quarter point, but hoping for up to a half a point in reduction in the Fed rate. And while that does not correlate directly with the mortgage market, right now what's putting pressure on the mortgage market is the lack of demand for mortgages because rates are so high. The banks are like, well, we want to place some of this money into mortgages. Housing's a nice stable asset for the banks to invest in. So they're lowering the rates a little bit in response to that. If they can borrow money from the Fed Reserve at a lower rate, then they will be able to lend that money profitably at a lower rate to the consumers. So that'll be two pressures pushing down on the rates and pushing buyers to get back into the market. So the point is, it is not great now, but anticipating the future means you should be getting into it right now. The best time to buy a deal is understanding that we realize the gains from our flip, generally 90 to 120 days from the date that we purchased that flip. So by anticipating where we think we're going to be 90 to 120 days from today, you can really decide if now is the right time to buy. And it's always a good time to buy a deal. That's an important thing to remember. Okay, no matter what the market is doing, up, down, sideways, whatever, it's always a good time to buy a deal. It's not a good time to buy a retail property. Obviously, obviously when things are super expensive, because if they come down, and they haven't yet, but they can. If you buy it at retail, you could lose money on that investment, right? But it's always good to buy a deal. The level of deal that you buy is wildly dependent on what the market conditions are. As the saying goes in real estate, you make your money when you buy, you realize that gain when you sell. Right. So you buy it accurately, you're going to realize the proper gain on the property, but you got to be willing to buy it correctly. And a lot of people get emotional about the buy side of this, and as a result they end up not buying it at all, or they buy the wrong property. A series of things can happen to rookie investors who don't understand the market dynamics as well, and they've got emotion involved in their decision. My job as a real estate investment coach, advisor, however you want to name that, is to keep the emotion out of it. Do the numbers based on the data we have today make sense? Do I have an incentive? Absolutely, I do. There's an incentive to help people get into properties because I make a wholesale assignment fee when I sell the property to my clients. But the bigger incentive for me is the profit on the back end. I don't make the profit on the back end. That goes exclusively to the client who bought the property. But by realizing or helping my clients to realize a profit, there's a much higher probability they're going to buy another deal, right? So I have a huge incentive on making sure my clients are buying deals because they will buy the next deal and the deal after that, etc. And honestly, I speak very fondly about my goal of 50 clients, all doing 4 deals per year. That'd be 200 deals. It'd be incredible living for myself, for my clients who are doing the 4 deals per year. And it's exactly my target that I'm going to achieve with this program. But the reality is 10 clients consistently buying 4 to 5 deals a year would be game changing for my team. It would keep my construction guys extremely busy, keep my acquisition guys extremely busy, my funding guy extremely busy, et cetera, et cetera, et cetera, right? So really, we just need the consistency, and that consistency comes from anticipating what the market's going to do next and providing accurate predictions on the market of the future. The market of the future should have lower rates, higher buyer demand. Are we going to see massive bidding wars again? I don't think so. I think we're going to see a bunch of multiple offers, maybe. I think what you're going to see is a normal retail market. Time on market will get back to 30 days or in that ballpark, which is about how much inventory we should be carrying. Whereas today we're closer to 45 to 60 days on the market in certain markets, right? So what we're going to see is a status back to normalcy. We went way too up on demand, right? And supply didn't keep pace with that demand. There wasn't enough inventory, so prices went through the roof. Now we're on the opposite side of it, where demand is kind of weak, supply is relatively high, so people are hesitant to make a buying decision right now. When we take that hesitancy out by removing the election season woes and getting interest rates back to a more palatable rate, and I think palatable somewhere in the mid to late 5s. Are we going to see below 5? Not soon. Maybe not ever, but definitely not soon, right? But are we going to get back to the mid to late 5? Well, we're there now on the VA and some of the Govy programs, right? So we get the conventional rate back down to the 5s, late 5s, early 6 range, and I think you're going to see demand spike back up. People are going to start buying homes, but more importantly, they're going to want to buy nice homes. That's going to be the big variable, because rates are higher than they've been and everything costs more. Cost to get stuff done is more. People are not looking generally to buy a property and then spend 40, 50, 80 grand fixing it to their likings, before they can live in it. There's not a lot of people who are buying retail who want that. And compare that to the car market, right? How many people are out there buying fixer-upper cars, right? They go out there, it needs tires and a clutch, but other than that, it's a nice car. I think there's definitely a buyer segment for that. Investors, flippers of cars are out there looking for these minor repairs, but the general consumer wants to buy a property that's turnkey, that their family is going to live in for years, and they don't want to put a bunch of work into it after they bought it. This is the opportunity for investors. We take these dilapidated older properties, and keep in mind, houses are not getting younger. Okay, houses by design deteriorate in condition. By design of living in it. And even if you're not living in it, just sitting there, houses go down. Everybody's seen a house with deferred maintenance. Everybody's seen a dirty, unmaintained house, right? We take those dirty, unmaintained, deferred maintenance properties. We do the maintenance that needs to get done. We bring them back to the modern times. We add a flair of interior design. My wife's an interior designer. We make the house pretty inside, so it feels more homely. It's got more trends with today's interior design elements, the color schemes and the grays and the tans that are more common today. We take out the older cabinets, we add newer appliances, we put in new countertops, we update the tile, we update the plumbing and electrical systems, both the system functionality, which has come a long way, and the look of it, the fixtures, the feel, right? And then we put it back in the market. The consumer's looking at Joe Schmo retail seller who's still got a dated property built in even the 90s or 2000s, which doesn't seem that long ago, but a house built in the 2000s is now 24 years old, right? Think about that, right? That's a 20-year-old property. So updating those properties, making them modernized, taking out the deferred maintenance and making them feel and look like new is what investors do. And in doing so, we profit from the gap between what we're buying it at, the rehab budget to get it pretty, and the ultimate ARV, which is conducive with what the consumer would have paid for a normal home in that market right now. So if they're looking at a normal home in that market versus a remodeled home in that market, which one do you think they're going to buy? Pretty obvious, right? So we provide that value, and by providing that value, we make a profit. So is now the right time to invest? It really is. Is now that we're seeing signs that interest rates are going to alleviate, and we felt like that was the case, for the entire last year. At some point, the Fed's going to figure this out, lower the rates, right? We really believe that. Now it's happening. We're seeing decreases in rates, which means demand is going to spike back up. We want to get out in front of that wave, start doing projects today. So if you're looking to do a deal, is kind of to tie this all in. What you need, in my opinion, is somebody to help you find the deal, somebody to analyze the deal with you and make it palatable so you understand all the ins and outs of it, somebody to fund the deal on your behalf. Me being a hard money broker, I can help to find you the funding that you need to get the deal done. Right? Somebody to fix the deal on your behalf. And we have construction crews and project managers and people. I have a huge team of people now who are going to assist you with the project management side of this to get the deal done fast, cost effectively, and below budget, or very least at budget, right? And then we have somebody to help you sell the deal, list the deal on the market at a substantial discount for what you would pay a retail agent, because we can negotiate with the agents based on the volume that the entire group can do, as opposed to listing one property. We're going to pay full retail commission on that deal, which is 3% right now, but going to be impacted by the future market as well. So that combination means you can do as many profitable deals as you want. There's a one-time upfront investment in the coaching. It's annual, but it's one time to get you started, right? And as long as you're making money, then I hope that you're going to do deals for years to come. And every year that we are making money together as your investment advisor, you would pay for that advice annually as long as it's working for you, right? Kind of a no-brainer opportunity, but somebody needs to be watching the market and understand and anticipate what's going to happen next. That is my role as a team leader and head coach. What are we thinking is going to happen next, and how do we get out in front of it and keep the clients making money and profitable, right? Economic discussion is never very much fun, but it does show you what's happening in the marketplace, and you can watch the rate trends. And I won't bore you with charts right now, but take the time out. Google mortgage rate trend, and you can see that they crept up dynamic a ton in the 21, 22 range. Well, 22, 23 range really. And then they peaked out, and now we're starting to see a gradual decline back down to some degree of normal. The Fed is worried about getting inflation back, so they are going to drop rates slowly, unlike how they increase rates. So we're going to see it trickle back down. But right now, the trend is definitely, based on what we're reading, that things are going to trend downward, which means investors should be very much considering getting into the marketplace right now and buying a deal that 4 months from now will be largely out of this election season at a different interest rate, and ideally a higher buyer demand at that point. So it's an opportunity. If you're interested in discussing that opportunity further, I would love nothing more than to chat with you. Let's hop on a call. We can go over how the coaching program works, how I can get you into a deal, what it all costs, what the guarantees are of my performance and my team's performance to help you get into a deal and make sure it's the right fit for you. If you love it, I'd love to have you aboard as a client. We're taking about 4 or 5 more clients for the year, and then going to cut that off for a little bit as we get caught up with the clients we're buying deals for right now. But now there's still an opportunity, a few slots left for people who want to get involved in doing a foreclosure flip. And I'd love to be your coach in helping you to do that. That's kind of our show for today, guys. I really appreciate you guys tuning in each and every single week to the show. Listen, if you want to talk more about it, reach out to me. Let's discuss it. This isn't for everybody. That's what we're learning. And for people it is for, we definitely want to help you to make the right decision for you and get you to the right property. Because if you keep buying deals, I benefit every time you buy a deal. My team benefits every time you buy a deal. And you benefit every time you buy a deal, right? Whereas a lot of the guru programs out there are about selling education and theory. This program is about results, helping you to actually do deals in this market. And I would be honored to be a part of that with you. With that, this is Donny Coram, your foreclosure deals coach. Thanking you so much for tuning in and reminding you now and always, don't buy a house, buy a deal.